All right, everybody. Hi, welcome to today's Cybersecurity Insight interview. And we're going to be talking to Amanda Conforti today. She's the Vice President for BWD Sports and Entertainment, and she oversees the management and cyber liability portfolios for the sports property and casualty department there. And she's responsible for her overall servicing, placement, and claims management of the portfolio. She's a licensed property casualty producer. She holds an MBA with concentrations in marketing and management from Rutgers, and her BA is in psychology. So please help me to welcome Amanda to the program. So thanks for coming, Amanda. And we're going to focus today a little bit on cyber insurance, but from a different perspective, from the perspective of coming from property and casualty and coming from what I call, 100-plus-year-old institution, which uses actuarial data and has a very different approach than what is needed in cyber insurance. So how did you first, I know you have an underwriting background, how did you get involved in underwriting?
Yeah, so it's a great question. When I first had graduated college, I think a lot of us aren't really sure what exactly we're going to fall into, and I had decided that, I was going to go the business route and had was studying actually for my Series 7, which is, for finance. And when I got to the chapter about underwriting and risk management, it was just, for whatever reason, it clicked. Nothing else was clicking. I found everything else to be very dry, very boring. And for whatever reason, that really clicked with me. And I was able to land a job with AIG shortly after that. And I spent a couple years kind of on the back end of things, more so in the accounting department. And when an opportunity arose for me to switch over to an underwriting group, I took it, and the rest is really history. And I've kind of stayed in that same area that I started in, 11, 12 years ago today. So.
Great. So talk to us a little bit about the underwriting process and how it works. I know we all know it peripherally, but I know there's a lot of detail in this, and it would be interesting because I want to contrast and compare later the casualty and property underwriting mentality with where we see the cyber underwriting mentality needing to go.
Yeah, so underwriting is actually it's different than I think most people think it is. It's something where it depends actually highly on the carrier that you work with, how underwriting is going to work. So there are some carriers where actually the underwriting is extremely basic. And you'll actually notice that at those smaller carriers that when sometimes you talk with the underwriters, they may not know too much about their forms or about, the risk at hand. And you can kind of tell when they work with a carrier maybe that does a little bit more deeper dive into the risks, that they seem to be a little bit more familiar with what's going on in both, the risk itself, in their form, in general in the marketplace. So growing up, and I guess not really growing up, but like starting out at AIG is one of those few carriers that I guess that they really kind of say that they train the industry, right? So a lot of people get their start and do a lot of time at AIG. And I have to credit them for that because, they really, on that side of the house, they do a lot of in-depth underwriting. So basically, the way it looks is you're given an Excel spreadsheet. It's going to have pre-established, rates in it where you're going to answer a series of questions, and then you're going to work with the rate to try to get it where you think you can in order to land the business. And there's kind of a delicate balance there, between trying to get to a price where you think you'll actually get the account, but also getting enough price to actually make it worth writing. And then you have to also look at things like, the limit and whether or not that's adequate. Are you able to get the retention that you need on the account? There's also a lot of, going back and forth, especially when you're getting new business submissions, as to whether or not the new business that comes in is something that really fits the risk appetite of the company. And, are you actually, is it something good to get on the books, or is it something where you look at what's already being offered maybe by their previous carrier and you know that you're not going to be able to compete on it? And there's also establishing, rate and trying to get rate over prior on renewal. So there's a lot of different kind of things that go into underwriting. But all in all, I do think that underwriting kind of gives you a really in-depth background on just analyzing risk for companies. So I do think that it helps set you up in the industry to move around very well.
What is it meant by retention? You mentioned retention. How would you define that?
So retention is basically like your deductible. So that's, if you have, your car insurance policy, that's what most people are familiar with. And you'll usually pick a deductible to put on that, like 250 or $500, whatever it's going to be. Now on the
Mhm.
business side of things, it's usually a lot higher retention than that. Sometimes you'll be able to see minimums that are $1,000. You see them sometimes still on cyber policies, but for the most part, on the lines that I work on anyway, the retentions are much higher, talking about, $10,000, $25,000, could be up to 100 to $150,000. So it kind of depends on the risk that you're working on.
So if I understand it correctly, the underwriter has some historical information that they are collecting from the person who's looking for a policy. It could be their prior policy. It could be different understandings around the specific type of information you need to understand how to underwrite the risk. So as an example, in property and casualty, it depends on what you're writing. If we're writing a car insurance policy, we're going to look at the age of the driver. We're going to look at if they've had accidents or DWIs. We're going to look at the kind of car they drive. Is it a flashy red sports car or is it a Volkswagen, right? um, and these are things that I think everyone can relate to in their day-to-day life. Is when I want to insure my home, when I want to insure my car, when I want to insure something else that's personal. But now we're looking at insuring something that's digital. And one of the things that I think is important to make a distinction about is that when the actuaries go to underwrite things, they're looking at historical data, right? They're looking at data that has been collected over a long period of time about statistics, about previous accidents, how old were they when they had an accident, fires, floods, tornadoes, what areas are more prone to have tornadoes, tornado alley. And when we look at cybersecurity as an example, we don't have that luxury. And even if we did, it doesn't mean that there's a correlation between your current risk today and what happened to you a year ago. Because if you had some type of a cybersecurity event, you most likely remediated it. So when you look at currently underwriting from a cyber perspective, do you see people understanding that? Do you see them frustrated? What do you see as or are they just doing it because this is what they're given and this is all they have and they're going to go with the flow? What are some of the things you're seeing?
So I would say if we're, looking at the cyber side of things, I think that in that house it's a little bit more that you find a passion in people, I think. So as far as underwriting goes, right, you have your basic, P&C underwriters, and technically, believe it or not, I mean, cyber actually falls under P&C lines. It's just considered a specialty line within that realm. And a lot of times when you see P&C underwriters, like just your general ones that you think about for general liability, auto, yeah, there's probably a little bit of them kind of falling into that industry, and maybe they just go through the motions a little bit more. Whereas in the cyber industry, I feel like you're starting to see more of that kind of passion. You're starting to see people who have been underwriting in it longer, who specifically sought out wanting to get into cyber underwriting because it's something that interested them. So I do think that, I mean, you'll always run into on occasion your underwriter who's a little green, right? You'll run into somebody who hasn't been doing it that long and who probably doesn't have the best understanding of the market. But there's usually someone that they either report to or work with who has to review what they're doing, who sometimes has to get involved if you have in-depth questions, who can help to answer those questions for you. But I would say that you definitely do find that your fair share now of cyber underwriters who are starting to understand the industry better, who have been in the industry longer, and who have that kind of passion for what they're writing and for their form to go after business in a way that is a little bit can I say like smarter than how the industry used to be even just 5-6 years ago.
Mhm.
So and I guess what I mean by that is, 5 or 6 years ago, there was probably a little less being done, research wise, into underwriting cyber risks. And that was really a push internally from the companies. It's nothing to do with the underwriters themselves. The companies were saying, well, look, here's this other carrier who's willing to just quote based off of having an address and having the company's revenues, and that's it, and they were basically putting out quotes based on that information. They'd say, all right, give me their website so I can go look at their website. They'd take the revenues and they'd put a quote out without really understanding um what that information meant. Whereas now, especially with everything going on in the cyber industry, with claims starting to worsen, with the carriers books starting to worsen in general, when it comes to claims, you're starting to see a lot more questions, right? So you're starting to see the request for longer applications. You're
Mhm.
starting to see requests for ransomware supplemental applications, because that's a particular claim that the carriers are getting hit really hard on. So they want to see what kind of, protections you have in place. And on top of that, I would say too, just going back to your original comment that, if you're an underwriter and you get a copy of, their previous policy, you're usually pretty lucky. Normally you don't get to see the other policy that you're trying to compete with. They usually hold that pretty close at hand unless they're really looking to move a risk to you. And then at that point, they might show you, hey, well, they have, this endorsement and they have that endorsement. Are you able to add this stuff onto your terms? But for the most part, that kind of stuff is usually held a little tighter. And the information that you're working for, like you said, is mostly historical. It's based on an application that they filled out. Sometimes, you used to be lucky to just get an application of any sort. It could have been even a couple years old, the last one that they filled out. There is much more of a push now to get more recent information.
Mhm.
But then on the underwriting side, you're also working with actuaries who are at least trying to analyze trends and who are trying to forward think about what is the market going to look like. Yes, a lot of that stuff is still historical that you can base it on, because it's very hard to analyze, well, what's going to happen to them in the next 6 months to a year.
Mhm.
But you work with what you can, and I think that that's the best that most underwriters can do.
Right. So one of the things that I also think is a big disconnect is the language. So I read a policy or I look at some of the questions that are being asked in the application process, and the terms that the carriers are using and the terms that we know in cybersecurity are not aligned,
Yeah.
right? And so we have this huge chasm of no standardization of language. As a matter of fact, I've been asked to join a couple forums that are working specifically on this, to help the cyber insurance industry to get its act together. But I think the problem we have is that because it evolved out of property and casualty, and the first insurance that was written was back in early 2000 for the Lloyd's market, and it covered only very minimalistic aspects of cyber insurance. And you said earlier that it's a specialty line that's come out of property and casualty, but we have our own standalone policies now. And I think the trend is starting to be more of a disconnect between the P&C policy and the standalone in terms of we need to address this head on, and we can't dance around the pieces of the P&C policy that don't apply to us. Like one of the things I think we struggled with initially, and I'm going back about 3 years now, when we first kicked off all the learnings and the stuff that we're doing on the insurance side that are related to cybersecurity, were that not only the language, that was the first problem, but the second problem was teasing apart that P&C policy so that the person who was interested in cyber insurance could understand it and not get tripped up in the language and the other aspects of that policy that were not applicable, like the media section of the policy is an example. So we look at the policies and we have D&O, which is directors and officers. We have EPL, we have K&R, which is kidnap and ransom.
Yep.
Which is not ransomware, it's kidnap, actually physically kidnap and ransom, right?
Yeah.
So we're talking, the Getty, the Getty kid. We're talking fiduciary crime, professional liability, et cetera. And they're not really language that's fit for purpose of what we're doing. So when we look at how that they're trying to put square pegs in round holes, in my opinion, that it's time to completely just erase the blackboard and say, we're starting off with a clean slate and we're starting off with the right terms and we're starting off with the right stuff, because limits adequacy, which is something that you hinted about earlier, right? Which is one of the first use cases that we teach, is really critical, first of all, because would you underinsure your house by 50%? No, of course you wouldn't. You wouldn't be able to have another house. It's like, so we need to be very clear about how we help them to get limits adequacy. And the only way we can do that is to take the cyber events that we have, like ransomware being one, right? Or a data exfiltration event, which has typically been labeled as a network interruption, which is ridiculous. It's not necessarily a network interruption that causes a data exfiltration. It's like, so we have this like really crazy gap that we need to get clear on. We've had a couple folks who are on the insurance side reach out for specific training. And we are going to craft for next year a complete class. We've already had 2 different companies reach out who are on the advisory board. So this is going to be something that's going to be a whole class instead of a module coming up.
Okay.
So stay tuned, everybody, for that. So let's go to the next question. We talked about this hardening of a cyber market, and I wanted you to explain to the audience, what is hardening exactly? What does that mean? What are the triggers for it? What would indicate that it's happening?
So when it comes to a hardening cyber market, you're usually looking at several different things all happening at the same time. So essentially, there's usually a start to it, right? So there's usually some kind of trigger that's going to start the cyber market hardening. Now, I'll be the first one to admit that usually whenever a market's about to harden, there's certain carriers that you want to watch to see what they're doing. Okay, AIG is usually one of those. They usually try to harden the market or try to start hardening the market before it's actually hardening. So I can say that about 3 to 4 years ago, AIG started really.
What does it mean, hardening? Like, what exactly does that mean?
So that technically it means that basically it becomes much harder to place insurance.
Okay.
Really it kind of boils down to something that simple, where it's harder to place insurance, it's harder to get the limits that you need, it's harder to get the retentions that you need. Like retentions are going to increase. Your limits, they're probably going to try to cut those from what they were originally writing and take on less risk. They're going to try to cut coverage potentially out of the form. So if it's a very broad-based form, they're going to try to carve some of that back and take that away so that they're not going to be on the hook for as many claims. They're
Right.
going to start increasing price, usually by at least a certain rate. It could be across their entire book, or they could target certain accounts in particular that they
Mhm.
consider to be worse accounts. So they could be higher risk, higher profile. It could be certain industry classes.
So literally, they're reducing their risk.
Right, exactly. So
Right.
it's the carriers really reducing their risk. And essentially, that usually ends up leaving everyone else in a point where they're scrambling, right? So you're trying to, get better, your clients always want to see that you're getting better coverage
Mhm.
than they previously had, right? So I kind of switched over to the brokerage side of the house now. So like really who I represent are my clients. I no longer represent carriers. And when, you're always trying to get them better terms year over year. And in a hard market, basically you're going to your client and explaining, well, it just kind of is what it is, here's your 20% increase. It was the best I could do. I did go out to market. I tried to shop your renewal. I tried to find better terms out there, but maybe because of that hard market, better terms are just no longer available. You'll start to see even carriers
Mhm.
pull out of certain markets altogether. So, right now I think we have, well, we had over 180 different carriers at least who were offering cyber insurance in some way, shape, or form in the US on their portfolios. And I think that when you have that much competition in the marketplace, it's obviously going to generate what we quote unquote will call a soft market. You're going to see that kind of trend where it's very easy to obtain insurance. You're going to have a lot of carriers who are willing to compete against each other for the
Mhm.
business just to get something in the door. But are they necessarily writing it in a way that's smart, in a way that's going to
Right.
keep their book, you know, bringing in money? And usually not. And then that's the issue, is that you'll usually kind of see this, you'll see like a trend in the insurance marketplace, and it'll differ usually by line of coverage. So the cyber insurance market may not be doing what the D&O market's doing, and and vice versa. And you'll
Mhm.
see that kind of trend where it'll stay soft for several years. You'll have all that competition driven. You'll have an easy time getting accounts on the books. And then you'll see it switch over to that hard market that, and then eventually it'll
Mhm.
go out of that hard market again and go back to a softer market where you're able to place
Right.
things
So
easier.
keeping
So,
your broker hat on, right? And
mhm,
like let's go a little deeper on this because I think this is interesting, is the way that the policies are built is a series of towers, right?
mhm,
And these towers, for those who've not seen this before, are different carriers. And you tell me if I'm saying this right, by the way, you're
mhm,
the expert, not me. Are different carriers, right, who are participating in this policy, whether it be
mhm.
AIG or Chubb or Zurich or AXA or whoever, right?
Yep.
And they are all taking a piece of the policy. So, as an example, if an aggregate limit, which is the total limit that the company would pay out in a year if there was a claim, usually based, by the way, on data exfiltration for everybody who is following this from our quantification side, is going to be a certain number. So let's say it's $70 million, just for an example, right?
Mhm,
And one company will come in with 10 and another will come in. So it's like this tower that is being built, right? Of 10 and 10 and 10 and 10 and 10 and 10 until you get 70,
yep.
you get 7 carriers with 10 each. And then you've got your 70 million. And then there's the sublimit pieces that have to be addressed, which are
Mhm,
specific to the type of cyber incident that you have, whether it be ransomware or a privacy violation where you're being fined, or a credit card on the PCI side, or a denial of service attack, which is a business interruption, et cetera, or a data breach, of course. And so when we say it's hardening, right? And we say that, and I think that one of the things maybe that could be hard for your job is to build that tower, right?
yeah.
But now it's hardening even more. So how much harder is it for you to build the tower when you've got, people who are, so maybe they would have taken 10 last year, but now they'll take 5, right? Because you said they're trying to reduce their risk, right? And maybe you've got 180 people in the market, but maybe like the prices on 80% of them are just ridiculously high. And so you've
Right.
got this 20% that you're really working with, right? What do you see there? How's that affecting the tower building and the ability to have an effective way? Because when I think of this tower thing, even before the hardening piece, right? To me, it's like, wow, that sounds really challenging. That sounds like I've got to get 7 different people to agree on this one thing
Yeah.
instead of one person to agree on this one thing and write a policy, right? So, what are your thoughts on that?
So the hardening market definitely makes it tougher when you do have a tower. Now, I will say that you don't have a tower in all cases, right? So some clients will just go and get whatever limit that they can get from one carrier. And in those cases, let's say they were able to get 10, right? But now because of the hard market, that carrier only wants to put up 5. So now you have to technically, in order for them to keep their 10 mil limit, you have to put a tower in place. You have to get a second carrier to come in and offer that extra 5. And the same thing kind of happens when you're looking at, a tower of 70 million, right? So essentially, when you have a tower, everyone higher up in the tower is going to follow what's happening on the primary carrier's policy. So it's most important that you get that really good primary carrier to do what you need it to do. So if they're willing to put up the 10, there's a higher chance that you can talk the other carriers up above them to stay at the 10 mil limit. But if that primary carrier decides I can't take on the previous 10 that I was putting up, I need to reduce this to 5. One, the easiest thing to do is to try to replace them, to try to then keep those other, markets following a 10,
Mhm.
right? So you try to find a
Right.
10 somewhere else. But if you can't do that, there's absolutely nobody willing to put up the 10. Then at that point, you're talking about, because they're going to cut limit to 5, now you're going to probably see everyone above them cut their limit to 5, which now means you then need to
Ouch.
double the number of carriers on your previous $70 million limit. Now,
Mhm.
maybe once you get above 50 million, the chances of having a claim are a little less that are going to breach that. It's really only going to be on like your very biggest of insureds who are going to see claims go that, like, your think think large companies, right? This is going to be like your companies that you fully expect that if they have a claim, it's going to blow through a tower, like your Target claims or your Sony claims, things like that. In that case, you would probably see the people also reduce their limits. But sometimes once you get past that $50 million layer, you might be able to get people to put up a little bit more. So they might say, okay, well, there's 50 million underneath me. There's a
Mhm.
very low chance that I'm actually going to have to pay a claim. So at this level, I'm willing to put up 10, or I'm willing to put up 20 or 25 or 15, whatever they're willing to put up. And you try to get more, or like, at least larger limits at the top so you don't have so many carriers in play. Now, the
Got
good
it.
thing is at least on the tower, you know, that first carrier, whoever is that primary carrier, does take ownership of the claim, right? So the good thing is that you always have that first carrier kind of in there, like handling the claim for you. You don't have 7 different carriers coming in trying to handle a claim for you, because
Mhm.
let me tell you, that's a complete nightmare, just even having more than one carrier trying to handle a claim.
I could
So
imagine.
you have that first carrier who kind of handles everything, and then the other carriers have already said, hey, we already agree with their form. We agree with the way that they handle claims. That's why we're willing to sit over them. So they're just going to go in and they're going to start pitching in their money. Once it's their turn, they have to just start paying the claim. So essentially, the other carrier is still kind of handling it for them, but they're the ones pitching in their money. They're the ones handling, the claim for the other carriers essentially
So
at that.
say you're okay, so you're in the process of getting cyber insurance, right?
Mhm.
And you're filling out the form, right? What are some of the things that would immediately put you into the high risk category when you're filling out the form that we would like to know about? Like, obviously, a data breach would be one, but what are some of the other things, like the top three or so, that might really make people reconsider or make your rate higher or something negative that would impact you? Thank you, Francois.
Yeah. So that's a great question. And believe it or not, it's a pretty simple answer when it comes to underwriting, at least what they're looking for. So really the things that are going to impact it most, believe it or not, is going to be industry class, right? So based on your industry class, how likely are you to get a claim? Now, if you're in the healthcare space or the retail space, there's a good chance that your claim is going to be a larger payout type of claim, or could spiral into a larger claim. So they might get, higher rates just simply because of what they do. That's really as simple as you could put it. The second thing that they look at is revenues. That's their main exposure base that they're using to decide, okay, well, first of all, how much limit do you likely need? How much revenue do you bring in? That's telling them how big of a company are they? How big of a target are you?
Mhm.
So the bigger your company is, the more revenue you're bringing in, the higher likelihood that your claim is going to be expensive, because in something like a ransomware type claim, they're going to demand more money out of you because you're a bigger target.
Okay.
Then, obviously, like you said, there's have they had past claims, but believe it or not, that's a little bit less of a risk to them, right? Because I'm going to be honest with you, one of the ways that the carriers look at it is if you just had a claim that you paid out, the chances are that you're less likely to actually have a claim, because now you're on heightened security, right? Everybody's on heightened alert. They're looking out for this type of stuff. They've already taken the precautions. They're being more careful. Their employees are likely being more careful because they just went through something. So actually, believe it or not, the fact that you just had a claim that was handled may not be the worst thing for your company, because when you write something new, and if you're looking to switch carriers, they're always gonna exclude that claim anyway. So there's no way that they're gonna cover that in any way, shape, or form if they're just getting on the policy. So sometimes that can actually be a benefit, or there's at least a way to talk about it in a way that becomes a benefit, which is something that brokers can use, right, to get the terms that the client needs. But I would say, if I had to pick a third thing rather than picking them having a claim, I would pick how they respond to their questions. So basically, what controls do you have in place to help you avoid a claim? If you are doing the necessary things, if your questions are all answered favorably for what that carrier wants to see, I mean, you can usually tell based on how the question's phrased what they want to see, right? That you do have the control in place. If you do, that's going to help you get more favorable terms. They might be able to rate you more favorably and give you better premium. However, if you're answering questions where, it's like, well, we don't really do that, or we're not really using, an outside IT based firm, or we're not really conducting, the annual or monthly or whatever checks they're supposed to be doing on their systems, or doing their monthly patches, then yeah, that's something that's obviously going to cause a red flag, and now they're going to charge more money for a policy that maybe you would have been able to get
Right.
the benefit of a lower premium on previously.
So along those lines, so you're a larger company, you've got a lot of on-premise systems, you're maybe having a cloud first strategy. Are they looking at differentiating? And this goes to risk accumulation issues that a lot of companies, the
Mhm.
carriers are struggling with, right? Um, do they favor those with more on-premise systems? Do they not favor those with more on-premise systems? How are they looking at, the cloud strategy versus the non-cloud strategy? Because obviously this goes to the control issue that you just
Mhm.
talked about. And they're evaluating controls that you've got a set of questions, you're answering them, right? If you have 98% of your infrastructure in a cloud service, then you're not responsible for a lot of those controls. The cloud service provider is, although of course you have to have your security program in place. You can't just
Right.
say, in Hebrew, we say Yehi Besayer. It means, yeah, everything's okay. And it's like, that's nonsense. It doesn't work that way. You have to have your program in place too, and you have controls that you own regardless. But um, are there any companies that are looking at it that way? Or are they just saying, no, it's just doesn't matter to us whether you're more cloud or more on premise?
So I think that there's two different ways that the carriers likely look at that question. So the way that, if you are using a cloud provider, right? One of the things that makes it a little bit easier for underwriters is that they say, well, if they're using an established cloud provider, then they probably have all of those security protocols in place that I want to see, right? So it makes it a little bit easier if they are using a cloud provider to kind of say, okay, well, most of the security protocols that I need are likely in place anyway. But then there's also the separate way of the way that a claim is usually paid, right? So ultimately, even though you're outsourcing that responsibility to a cloud provider, if you're the ultimate collector of that information and then it's just going to the cloud provider to hold it, you are still the one responsible. So now, if the cloud provider is the one who's breached, your policy is still the one that's going to get hit with the claim because you were the company who collected the information. So really, it's more of like they have to check to make sure, I guess, that they're comfortable with what the cloud provider is doing. And in most instances, you'll see that the client, when filling out the application, is likely to go to the cloud provider to get the answers because they don't know how to answer most of the questions on their end. So they're likely to go to whoever they're working with to kind of answer the security protocol questions. Um, but I do think that, it's kind of the two-prong approach where you're a little bit at higher risk because the company isn't totally aware of what's going on with the data and what that cloud provider is doing and whether or not necessarily they're getting hit with a claim on the cloud provider side. But also knowing that the cloud provider is taking all of the necessary precautions to try to make those claims come in at a minimum is
So
somewhat comforting.
let's take that example because that's a really good example. So, okay, I'm the company, I'm the first party. I have my data. I'm sending it to my cloud service provider and they are processing and storing it on my behalf and they have a data breach, right? Now, I've already got my own insurance policy.
Mhm.
I am responsible to notify everyone because it's my data, right?
Yep.
So I'm going to execute a claim against that. What are they doing on their side? I would assume they're also executing a claim. Is there a crossover between where their liability is and your liability is? Because we all require them to have insurance, right? So we say,
Yep.
"Hey, cloud service provider, you must also have insurance." And we tell
Mhm.
them what it is, even though half the time it doesn't make sense how much we tell them, but we won't go there right now.
Yeah.
um, so what's that dance look like between my cloud service provider has had a breach and I am now in the process of, filing my claims, notifying my um, data subjects if it's the EU or my consumers if it's in the US or whatever. What does that look like?
So normally when you're working with a cloud service provider, they're gonna have like that established vendor contract, and normally like in that agreement, like you said, there's a specific language on how much each side is supposed to hold on cyber insurance. So essentially, you would suspect that if the cloud provider were the one hit with a claim, and let's say it hits multiple of their clients that are affected by this claim, that their policy is obviously going to get hit. They're going to put a claim in under whatever insurance policy they're purchasing, which is probably way higher limits, I would hope, than whatever the company is asking them to actually have. Now the thing is that those vendor agreements that are in place a lot of times limit the liability that the cloud provider is actually responsible for when it comes to that client. So maybe it caps it that, they're only going to provide you with, who knows, $250,000 towards your specific claim. So what happens is that the company itself needs to have its own policy, and they'll put in a claim, like you said, under their policy. Now they may not be the reason why the claim happens, so there could be something that we call as subrogation, right? So that the carrier could actually decide in the claim that they're going to subrogate against the cloud provider's insurance policy and try to get some of that
That's
money
what I
back
wanted to know.
from the
Yeah.
from the claim that they've paid. But there's also a specific type of insurance on the cyber policy called contingent business interruption, which really is meant for this specific instance, right? It's meant for your business has been interrupted because somebody else's business was hit by a claim or a breach. And essentially that provides usually now it's up to a full limit for you to help you because in most cases whatever you're going to get from that other cloud provider is going to be a like chump change compared to whatever the claim might actually cost you. So you
Right,
actually do need that cyber policy to come in,
right.
and then
Yeah.
you let the carrier worry about getting their money back if that's what they want to do. If they want to go subrogate against the other carrier, then that's fine.
Makes a lot of sense. Yeah, this is interesting because when we do the adequacy for, clients, one of the things that we do is we do dependent and non-dependent, which is contingent and non-contingent business interruption, which is what you're talking about. The subrogation angle is very interesting. This also kind of goes to my next sort of four-way is, okay, so I'm the cloud service provider and I have a vulnerability in my S3 buckets, right, or whatever, right? And it's not just hitting me, the company, it's hitting everybody else, right? So one of the things that I see, and I think the hardening market is being driven by this as well, is this whole idea that there is no way to diversify across the technologies. And this is why digital asset approach is so important, people. There is no way to diversify across the technologies of that cloud service provider. So when that cloud service provider gets hit with the vulnerability or the incident, and it's going across the entire portfolio
Yeah.
of everybody who's on that cloud service, regardless if you're multi-tenant, single tenant, private, hybrid, it doesn't matter. It's a vulnerability or a technology issue. What I'm hearing, and Munich Re reached out to us about this last week, was that there is no way right for them right now to be able to understand even what that looks like.
Hmm.
Um, and that's something that I find to be very, very interesting and something that's going to cause the cyber insurance market to possibly choke. Because if you can't understand that, and we keep requiring companies to have more insurance, and we keep requiring more and more different companies to have insurance,
Mhm.
that is related to cyber, then how are they going to support that? And that's my concern as well, is that right now the methodology that they're using is not fit for purpose, and it's
Right.
going to choke the market, right? And if they choke the market, then what is everybody going to do? They can't pay ridiculous premiums for insurance. There has to be a better way for them to be able to understand what the real risk is that they're actually standing behind. And that's why I started off the conversation with the underwriting part of this, because I don't believe that they are looking in the right places. The questionnaires are limited, and I want to get to some of the folks on the phone who have some relevant questions here. So I'm going to just pick a couple. And somebody wants to know when dinner is now, in what time zone. Okay, Israeli time. Here we are. Um, okay. All right, I'll just pick a couple different ones because there's a lot of good ones. So one person is asking which control definition, since control definitions are pretty vague, how does the insurance company check if the answers are true from this insurance understanding of controls? Do companies need to produce proofs on the controls and their current status?
They do not. So I would say for the most part, so you have insurance companies who write this type of insurance two different ways. There are a couple of carriers out there now who are doing kind of their own IT reconnaissance via the internet to kind of see whether or not those controls are in place, and that's what they're largely using to base it on, right? So they have very
Yep,
simple
yep,
renewal applications
mhm.
because they're doing their own kind of reconnaissance work to figure out if it's a good risk. But
It-
then you have carriers who have lengthy applications who ask a lot of questions.
mhm.
And for those carriers, they don't have the IT understanding or background to really know how to check for that information. So really it's the honor system. That's the way that any application works in the insurance industry, is that it's an honor system. They're hoping that you're giving them the correct information, and if it comes back, if you do have a claim, they might try to hold you accountable if you've lied on an application, but rarely does that ever happen. So it really honestly goes largely by the honor system on the
And this
carrier.
is interesting because the Department of Defense has had it with the honor system. So those of you
Yeah.
who have been following CMMC, now everyone's going to be audited. So all the third parties that are working with DoD information are going to be audited. So this is another gaping hole in this whole thing. I'm going to go to another question because I want to make sure I get to everyone's questions. We've got some really good ones. What is the best course of action if you have a great incident response partner, which is not on your carrier's insurance panel?
What- Sorry, can you say that one more time?
Of course, yes. What is the best course of action to take if you have this great incident response partner, but they're not on your carrier's insurance panel? In other words, they're not authorized to be able to provide you the service via the carrier.
Got it. So there are a few carriers that will allow you to add someone to the panel. But that's kind of, I'll be honest, it's rare. The carriers like to work with who they've been working with because they're kind of, proven to them. But and they have pre-established rates as well, which helps. But I think that, there are a couple carriers out there who will allow you to work with somebody else. In that case, the best course of action is if you want to work with somebody else, you have to try to, one, partner with one of those carriers who will allow for that. And two, you have to make sure that when you're either renewing or first placing the policy, that the carrier knows and understands that you want to work with that specific carrier, the specific firm, and get them listed on the policy before a claim even comes in for the carrier to be totally comfortable with you using them.
Mhm. Okay. Another question. What is the standard deductible? We had $50,000 and we're told that was no longer common. We had to raise it to 100,000 to reduce our overall premium 10%. It was a good trade-off price-wise, but still. In addition, a second question, why don't insurance carriers take into account our certificate? Okay, let's stick with question 1 first, and then we'll go to question 2. All right, so did you get that?
So I would say that there is no standard retention. It largely depends on the size of the business. So the reason why they likely had to go from 50K to 100K was because it's a larger risk company where 50K is no longer a feasible retention. You have to remember the kind of insurance, cyber insurance in specifically kind of acts more like what we call catastrophic insurance, meaning that whatever that retention is, you're likely to go over the retention if you have a claim. So essentially what they're saying is if we think that the minimum retention that your company can have on here is 100,000, it's because we fully expect that any claim that you're going to get is going to be over $100,000. And that's the minimum amount of skin that we want you, Mr. Insured, to have in the game if you have a claim.
Great. And then his second question is, why don't insurance carriers take into account our certifications like PCI Level 1, SOC Type 2, NIST, FSMA, and give us a lower premium?
Honestly, it's because a lot of different companies are starting to follow those frameworks and are starting to do their due diligence before applying for coverage. So, it is, I can't say that it's not used at all. Like, it definitely is used. It's just that, once again, when you go back to the questions, are they actually specifically asking questions about it? And honestly, most underwriters do not understand IT enough to know what those things are and to know how they're going to help a client, avoid claims. So unless they have a question that specifically addresses this and it falls into that narrow box that an underwriter is used to underwriting in, they're not going to know to answer that question, and they're not going to know to take that information and give you, some rate back. Now, if you have a good broker, your broker will argue it. They'll come back and say, hey, look, like, my client is doing all of these things. Is there any kind of reduction that you can get me in my premium for this? And maybe after they've quoted, they'll come back and they'll knock $1,000 off of the price or something. It is possible to do it. It's just not always likely that the carrier that you're working with specifically would be able to do.
So this is interesting because this goes back to these insurance companies asking to understand the digital asset way of looking at this stuff so they can actually go back and look at these different certifications that people have spent a lot of money and a lot of time on, frankly, to go back and say, first of all, to verify. That would be one excellent way of at least getting some level of verification. And then secondly, to provide value back to people who are actually taking it seriously and are doing the assessments and are using the best practices that are prescribed here. The fact that they're not understanding IT is concerning
Yeah.
because it's an infrastructure problem. It's a digital asset problem, for God's sake. So this is again going back to, square pegs and round holes, property and casualty mentality, not a cyber mentality. Let me go to another question here. Looking at the trend of accelerated digital transformation across many industries, should we expect premiums to steadily rise over the coming years?
Okay, so before I go to that, I did just want to kind of make one comment on what you just said, Ariel, too. Like basically when it comes to these applications, right, and the questions that they are asking, I want to just kind of put out there that when carriers did start first writing cyber insurance, the applications were extremely lengthy. And they were trying to really get at the nitty gritty and to understand everything about what these clients were doing. It was the industry itself. It was other carriers coming in saying, well, I can underwrite this with less information, that pushed that away, right? So essentially you had a lot of different carriers saying, well, I'll do it with less information. So then of course what you'd have is the insureds wanting to only complete less information and provide less information. So really it's almost like the industry itself is its own worst enemy. They wanted to have all of this information up front. When they first started really getting into underwriting cyber insurance, the applications, they were trying to get all of these questions. They were trying to fully understand this stuff, but it was the industry and the clientele pushing back on that that made them accept less information, to the point where it got that they weren't asking for any information at all and were underwriting this type of stuff, and and trying to get the information later. And I think when you perpetuate that, you perpetuate the industry really not knowing and understanding what they're doing. So
Yeah, I
honestly,
would go
like,
with quality versus quantity, right?
yeah.
It's what they're asking for in the context of what this company represents as a risk profile. I think that the one size fits all doesn't work. Asking for 300 questions. I mean, I remember when we did ours 3 years ago. Yeah, it was like 300 questions. It's really about understanding the business and what they're going to be exposed to, and then looking at it across more of a, okay, let me get the first level of information and let me ask maybe a second level of questions that are more specific to the context of what you told me in the first level of questions. And so I just think that there needs to be more done, but
Yeah.
okay, let me just,
Absolutely. And I'll go back to the other question too, because I know you
okay,
just you
great.
just posed the other question.
Yep.
But yes, short answer is yes. I expect premium to steadily increase probably over the next 3 years. There's needed to be a market correction in cyber for at least the past 5 to 6 years. They were largely, the policies were underpriced. They've been providing a lot of additional coverages, really broadening their forms, and still not increasing the premiums basically for years. So essentially, the market just started to harden, I'd say in November, after SolarWinds was really when you saw a very quick switch in the marketplace. And then even more so in January, that it started to harden, mostly just new year, so now they're starting to basically clean up their entire book. And premiums are probably going to be up about 20 to 30% depending on the carrier this year. And I do expect that will likely continue over the next several years.
Yeah, Marsh even said that they had started to harden back in August.
Yeah.
That so some were hardening, sooner than others. All right, so we've got a couple minutes left. First of all, thank you very, very much. This has been really fun. Learning a lot here. I wanted to know, final thoughts. What would you like to leave the audience with? And kind of go from there.
So I guess final thoughts would be, don't worry, about the hard market so much on the insurer side, where you're worried about, well, what's my policy going to look like? I think that what you as a client need to be more worried about is who you're partnering with. So make sure that you have a broker who actually really understands the cyber insurance marketplace and the coverage. There are a lot of brokers out there who will sell you cyber who know just enough to be dangerous, I guess you can say, who kind of can pull the wool over your eyes and make you think that they know a lot when they really don't. But really look for those brokers who understand the forms and are going through and saying, well, look, this carrier is better here and they're not as good over here. There's a lot to know when you're looking at these different firms when you're looking at these different carriers forms, in that not all the terminology is the same across all forms, which Ariel had mentioned previously. So you need someone who really understands that, like, this term might not be called the same thing from this form to the next, or they might be defining it differently on one form versus the next. And look for somebody who's really just going to help you weather the storm through the hard market, because that's their job, right? That's the broker's job, is to help you make sure that you have the best and procure the best insurance that's available through the
So
hardening marketplace.
a knowledgeable person. So
Yes.
thank you so much, Amanda. So for those of you who want to learn more about cyber insurance, I wholeheartedly recommend that you take the course at PACE. We have a whole day of this, and Amanda's just been touching on what I'd call the periphery, which is great, and pointing out some of the ways that this is complex. It's fascinating, but it's complex. And so if you really want to know more about this, take the course. If you want to do limits adequacy, come see me. We know how to do that. We can help walk you through it. And Amanda, thank you so much. This has been really fun and enlightening. And we'll see everyone on the next Cybersecurity Insight interview. Have a great one, everyone.